You are listening to a paid program. Advice and opinions expressed during the program are purely that of Synergy Bound Wealth Management, not necessarily WBEV or Good Karma Brands. Welcome into Taking Care of Business. Today on the show, we do have Spencer Butterbrodt with Synergy Bound and a few additional disclaimers we're going to go ahead and get out there for everybody. We want to remind everybody this is an economic forecast. An economic forecast set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not guaranteed of future results. All indices are unmanaged and may not be invested into directly. There's also no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. Really good disclaimers to have, and we'll talk about why those are good to have, and we'll talk a little bit more about everything that goes along with the market and volatility. But before we get to that, how you doing today, Spencer?
Good, Ninja. It's great to be here. Thanks for having me.
Glad to have you on the show. For anybody who doesn't know who you are, doesn't know anything about Synergy Bound, give a little details to people out there in the listening world.
Yeah, great question. So ultimately, I'm a financial advisor. I own and operate Synergy Bound Wealth Management here downtown Beaver Dam, 121 Front Street. Personally, I'm from here, grew up in Beaver Dam, moved back here about 2 years ago, actually 2 years ago to the date. And me and my wife have a dog, Bango, the Bernedoodle. He gets seen around town at Uga and other establishments. So we've enjoyed our time back in the community and opened up the office in January of this year. And so that's, ultimately where I'm at right now and who I am.
So you open up the offices in January of this year, and you are open now during an incredibly volatile time in the market. A lot of things happening and going on. Why don't you give us a little bit of a kind of a market update as to what's happening right now?
Yeah. So, right now, year to date, it's been a rocky time for investors, specifically stock market investors. Those with 401ks, IRAs. It's a tough time, turbulent time. Most of it is coming from tariff news, right? And we've heard a lot about it since February now, and it's been going on, news of it for 2 months. Markets do not like uncertainty, and right now we are in a period of uncertainty. So that's where this volatility stems from. Could have some lasting effects on business income. Forecasters, analysts are trying to determine what the right profit per share is for a lot of our American companies and what the potential impact is. And it seems to be changing on the daily, hourly, weekly. So there's a lot of updates coming through, and I'm here today to kind of, break that down, try to keep it as simple as possible for us to relate to our listeners, but also be here in a spot of reassurance and a spot of offering my help, right? And I tie back markets and uncertainty and volatility a lot of times to your unique personal goals. And I think that resonates a lot with my clients, is that I do plan for volatile times. We've been in these positions before, and it's kind of that ability to say, this is all part of your plan, right? We sat down, established your, a lot of times, retirement plan, and I said 10 to 20% corrections and bear markets will come around in our time together as investors. And it's navigating those and making sure that the proper risk tolerance is set up, proper expectation is set up, and then ultimately breaking it down and finding opportunity within uncertainty.
Now, we do want to let everybody know the phone lines are open. If somebody wants to call or text, they can definitely do so if they have a question for you directly. The phone numbers here at the station, 920-887-9595. That's our call or text line. So if you want to text in, our producer up in the studio, Jeff Hall, would be more than happy to take your text. You can also give us a call at 920-885-4446. And Spencer, you'll do your best to try to answer the call. Obviously, specifics are hard to get into sometimes with a quick question, but you'll do your best to kind of answer those broadly.
Absolutely.
If you want to get a hold of Spencer's office, I've got the number here, 414-299-0003, and then call the office there. The office open like normal business hours? Can people just swing by?
Yeah, normal business hours, usually about 8:30 to 4. I'm there. I do have an office in Milwaukee. So Synergy Bound was established last year, January of 2024. Opened up Milwaukee office, made my move. I had a lot of clientele in that area, and then branched out here to Beaver Dam and Dodge County area with the Beaver Dam office this year. So if I'm not there, I'm probably in my Milwaukee office. So always good to give me a shout before stopping by or schedule an appointment. but happy to take walk-ins as well.
Well, there you go. While we wait to see if anybody decides to call or text in, let's dive a little bit more into this. So we talked about the market volatility right now, and like you said, uncertainty is kind of an enemy of the market, and that uncertainty is coming from a lot of these discussions with the trade implications, dealing with tariffs, and that's a word that many of us are just kind of getting used to hearing over and over and over again.
Yeah, let's break that down. What is a tariff?
That is a great question. What is a tariff? The best I can understand, please correct me if I'm wrong, that's essentially a fee that gets paid on any product imported into a country. So if you import something from, Bangladesh, I'll just throw that as a place out there, Timbuktu, wherever, and it shows up and you say, okay, this has got a 5% tariff and the value of it's $50. Well, then they throw a 5% price hike on that.
Correct. Yes, it's a tax on imported goods.
Right.
It's a tax that strategically is often put on to have a desired outcome from the United States. Sometimes monetary, sometimes non-monetary, and our current environment is a mix of both. So the recent tariff news comes from the current president's viewpoint on trade is that there's a trade imbalance, and that's number one. There are some non-monetary that I talked about, and that's right now the focus is fentanyl and the drug problem that is occurring. So that seems to be another topic of negotiation. So initially, it seems like tariffs are being used as a negotiating tool to get a desired outcome. That outcome is yet to be determined, and that's where the uncertainty is, and how long lasting, and what is the final number. We've been hearing some strong tariffs come off first, and then some backtracking, and then some strong ones on China, right? And so we're in this period of we don't know what the final tariff percentages are going to be, and what negotiated deals look like.
And that adds to not only the uncertainty in the sense of, we don't know what that's going to be from day to day, but for these major companies out there that might be making products that have to import pieces, parts, electronics, whatever from outside the country, it's hard for them to keep a steady price to the consumer without knowing what their prices are going to be.
Yeah, and I think that's overlooked, right? We hear tariffs, we look at the monetary number, and we say our prices are going to go up by X percentage. Well, there's this period of uncertainty that a lot of our local manufacturers, a lot of our local businesses are stuck, and they want to know what it looks like so they can do proper planning. And so when there's this period of time that we're stalled out, we don't know what it looks like. So are our businesses. They go into conservative mode where they know they have to protect their baby, their business, right? And they protect it by making sure they're observing current market environments. And so that's going to be a big impact if we keep extending the period of uncertainty from a business standpoint. It could have a lasting effect in the economy, potentially cause a near-term recession. Right.
And I guess that's probably helps clear up some of the confusion, because I know people that have said, well, I've got, stock in Apple. Why is Apple's stock dropping? They're an American company, They are, but where the phone's made, where the parts made, where everything else is made, and if you don't think that far in depth into what you're talking about, it's hard to understand why volatility is hitting those areas.
Exactly. Yep.
That is absolutely crazy. It's weird how it's all interconnected. Now, I know you said we've seen this historically before. There's up and down times in the market. I've heard people say, well, ultimately the market is always going up. Even if it drops a little, it's always ultimately going up. Is that enough to make us take a sigh of relief?
Again, I tie it back, and for proper legal reasons, I probably keep the word always out of my mouth.
Right.
But I do say that we're focused on the long term, right? And I've got stats here. The percentage of times that the S&P 500, which is an index that represents our largest companies in the United States, over a 3-year rolling period, you have an 85% chance to come out with a gain in that any 3-year period you pick, 85% chance, right? And so that's where you often hear people stay invested, be invested for the long term, and because history has shown that is a viable thing. Of course, history doesn't predict future results, and that's always the disclaimer that you hear on TV, on radio, and advisors are always setting that expectation. But historically, long term, I look at it on a case-by-case individual risk tolerance standpoint. I often say if we're in retirement or nearing retirement, it may be time to secure some assets down, right? Maybe the next 3 years of your living expenses should not be exposed to volatile times. Maybe we should be looking at shorter term bonds or money market funds to put that mind at ease, right? And that's what it comes down to a lot as well, is how comfortable are you when you see that dollar amount that gets impacted. And that's what I work to find for my clients.
And so what I'm hearing is kind of the word diversification come out.
Yes.
Don't have everything just in one area, because if all of your planning was on the stock market right now, you're scared.
Yes. Yeah. And the most important time for retirees is that first 5 years of retirement. It can really be the key to success over the next 30 years. And so that's where diversification does come in. There may be times that a retiree can have 100% stock exposure. It might be. Maybe they are very risk tolerant, right? And maybe they are savvy and say, I'm under the belief that it will go up over time, that we often hear. But then I have others who simply need the help. And I kind of come in with a recommendation of let's plan this out year by year, right? What does the next 3 years look like? And let's set proper diversification to achieve our goals.
That makes a lot of sense. What would you say to people who are right now looking at the market and saying, it's garbage, I got to get out, I got to pull everything out? They're knee-jerk reaction people.
Let's talk, right? And let's understand where those feelings are coming from. I have clients. I've had the tough conversations, over the last 2 months that should we be invested, should we not be? And oftentimes the human psychology, when things are not going well, you want to get out, right? And then they often say, well, when things settle down, then it'll be the right time to invest. I often go against the grain on that, right? It's about the opposite thinking of what you want to have, right? When times are uncertain, when the market goes down, remember, every dollar you put in, you're buying more shares at a lower price, right? And so when our rebound happens, you're going to come out in a better spot. So I think, and then I have others where maybe it is appropriate if you have the need for a down payment, or that you have a large purchase coming in the next year, right? I don't have a magic 8 ball to tell you what the next 12 months look like. Right. So let's maybe have the conversation about where you're allocated and what we can do.
Now, of course, that decision that an individual makes on whether or not they should be investing in the market now while, it's down, to hope for that rebound, a lot of that is dependent on their current, liquidity, what they have available. And that's part of why the discussion with you is so important.
Yes. Yeah, absolutely. That key of not overstretching ourselves. We always want to have our emergency fund, safe and secure, and I want my clients to know that, if they're out of job for 6 months, we have something to fall back on. And then there's a lot of cash out there, right? That interest rates have come up over the last couple of years. You can earn a risk-free rate in a money market or high yield savings account. That's attractive right now. Those monies don't fluctuate, right? But the writing on the wall, I think rates eventually here come down. Federal Reserve will cut rates at some point this year, in my opinion. And that rate that you're earning on the money market or your CD is bound to go down. And if maybe you don't have a risk tolerance, there are other options for you that I can still do better, right? And over the long term, than your short-term rates if the money's meant to be longer-term in nature, but yet not necessarily take on a whole lot of risk, right? And so I work with all ends of the spectrum, from zero risk to, hey, I'm willing to take risk with this.
Let's explain to people a little bit who maybe are still kind of not understanding how the markets work, in the sense of, because you hear, well, the Dow is this, the S&P is this, the NASDAQ is this, and everybody's like, well, how do I know where my money is? How do I know what's going on? I've got a 401k and that's where my money is. What are they invested in? Like, how do you break that down to people?
Yeah, and again, case by case, there's a lot of different options, from 401k providers to what the individual actually selects when they sign up for that 401k. Always smart to review that at least on an annual basis to try to educate yourself. It can be confusing, right? And but I think trying to get that pie chart of, okay, how much am I actually allocated to? So when you're logging into your 401k provider and you're looking at that pie chart, or you see that statement come in the mail, that allocation, maybe a target date fund, right? Maybe you have a target date fund that's 2045. What that means is your allocation will get more and more conservative up until that retirement date, which you said was 2045, and that's right. Most common from a employee standpoint. And sometimes people just have no idea and they need help, right? And that's kind of where I come in, break it down. But generally speaking, most allocations, I like to use the S&P 500 as my broad U.S. stock market barometer, right? The Dow has been a popular choice by many through the 80s, 90s. Now the S&P 500 is a market cap weighted index that represents 500 of the largest companies in the United States. So that's kind of a starting point, right? If you want to check in and say, I wonder how my money is doing. If you want to know where your stock allocation is, you can probably do a fair benchmarking with the S&P 500.
Now, you said the word market cap on there. Explain what that means.
Yes. So the market cap is different than an equally weighted index, right? Or a price weighted index as well. So market cap, and right now the S&P 500 has recently been overtaken by, say, the Magnificent Seven, right?
Right.
Which is a lot of the tech companies, Apple, Nvidia, Google, Microsoft, and the likes. They have done extraordinarily well over the last couple of years, and so they have now been representing that index more and more. So in a way, there's a couple large stocks that are driving the S&P 500, and that's more abnormal over the last 2 years than it has been over the last couple decades. So it's something that I've been keeping my eye on, that we are properly diversified, right?
Right.
That if those companies, or if tech ends up being the most hurt in a trade war, that maybe another basket of eggs is over here where it's not as heavily weighted there. So that's kind of how that is represented in the index.
Now, is it still common for people to, because I think back to when I was younger, my grandfather for a while had this policy where every time a grandchild was born, he bought so many shares of, at the time it was U.S. Steel. And then that was gifted to the child when they reached the age of 18. And so I think I had like 4 shares when I turned 18 or something. Nothing major, but it was just to get us thinking about investing. Is it still common for people to try and buy individual company stocks, or do people tend to branch into those, like the group?
Yeah.
Like tech.
Right. Yes and no. Sometimes you'll find a grandfather or grandmother that really has this emotional tie to a company. Maybe it's a local company, right? That's a publicly traded company. And you'll see some of that. Oftentimes, usually it's broad diversification, whether it's from an ETF or a mutual fund. That's kind of most common that I see. And a lot of times that's setting up an UTMA account where it's a custodial account for the benefit of said child, right? So still common that initial planning and that deposits for birthdays and Christmas and that type of stuff are still happening, which is a great thing, very powerful for those kids to start to learn and be exposed to it through high school and eventually post high school as well, because when you start early in your career, that's the best time to really put your hands around investing and where you're going to get the most compounded return after 20, 30 years of doing that.
Let's talk about young investors a minute. I've got a 16-year-old daughter, works at the Pig up in Waupun. Good kid. Other day said, Dad, I think pretty soon I'm going to start thinking about how I can take some of my savings and put it away. And they were talking about like, I should do some CDs. And I thought, how do you even know what that is? And then it was, and then I'd like to talk to you about seeing if I can set up some sort of market portfolio. And I'm like, you're 16. What do you mean you want to set that up? I'm at 16, nowhere near my thought process. I was like, is my car got gas? Do I have enough comics to read? Like that was my lifestyle at 16. Do you have any advice for people that young?
Yeah, it's pretty cool, right?
Right.
It's cool that this generation is learning. I've been exposed to it and I've been amazed. And I think some of it is a shift from older generations. They had a pension to rely on. Pensions are few and far between nowadays, right? Unless you're a public employee, corporations, not many of them have a pension system anymore. And so I think there's been this shift where younger individuals, younger professionals have starting to be exposed, and they're like, oh, this is on me now, right? This is my responsibility to save and be smart. And I think the ability to go out and research, right, is amazing. Obviously, your daughter found that information from somewhere, likely online, right? And that ability to find information, be self-teaching in a way is powerful. So back to your original question. What was your question?
Yeah, like what advice do you give a young person who wants to invest?
Yeah. Be smart. and slow with it, right? Get exposed, start to learn a little bit, have fun with it, right? And this is kind of, usually I'm not a huge individual stock selector, but it can may be a way for a younger individual to be like, oh, that's how a stock works. I am an owner of, XYZ company. And now when they go report earnings, or when I go spend $1 there, a small portion of that's coming back to me, right? And I use Starbucks, as a common one, Walmart, right? So when you're shopping there, in a way, a portion of that you're paying for that cup of coffee or for your groceries is coming back to you in the form of either a dividend or, income to your stock. So kind of just a cool way to think about it from a young person's standpoint. And then, be diversified as well. The bulk of your money should probably be in a diversified bucket. So that way you're not experiencing a large drawdown that may scare you away for future years.
Makes a lot of sense. As we're hitting the bottom of the hour, I do want to remind everybody this is a paid program. Advice and opinions expressed on the program are solely that of Synergy Bound Wealth Management, not necessarily WBEV or Good Karma Brands. When I think of youth, teenagers especially, I think that sometimes they're very in touch with what's going on in the world, and sometimes they kind of have their own little universe they live in. And sometimes that universe is ruled very much by emotions. I think about, as a 40-year-old man, if I saw the stock market doing well, I see my money out there and I feel good about it. If I see things drop, I'm going to get emotional. I imagine for kids that's going to be hitting even harder. Any advice on whether you should they come in and see somebody like you, or can they take this journey on their own?
It's a tough question, right? And as financial advisors, sometimes we have minimums, and having that trade-off of having it be worth our time and also helping and giving back, I think there needs to be a better solution. And maybe it's, a volunteer opportunity that we can, get out there and put on a class, and say, okay, put this out to the school system and say, come learn, try to dip your toes in without us having to sit down with 20 different individuals and spend, 20 plus hours without being compensated for it. So maybe you just brainstorm something for me there, Ninja.
Maybe. Along those lines, you talked about a lot of these kids, they're learning a lot of stuff online. And we know the internet, not everything you see on the internet is 100% true and correct. And, some of it can be misleading and scamming. Any advice for people as far as things to look out for?
Yeah, I would say, blogs out there are common. Other individuals making recommendations are common. I tend to steer away maybe from there for the beginner. And I say, look for a reputable company, a large, company that's out there to find your research or to find that beginners. Because there's a lot of it out there. Obviously, there's thousands of articles that you can find. Try to find a large institution to maybe read from, and I'm happy to send out any resources to anybody listening that's in a similar position.
My follow-up question is in regarding to something that's kind of it's growing and it's getting bigger. And of course, thanks to one particular cryptocurrency, it has drawn a lot of attention. And that is cryptocurrencies in general. Bitcoin obviously being the big one that everybody talks about. There's so many out there. What are your thoughts when it comes to making crypto a part of your financial planning?
It's a good question. I personally do not invest in crypto for my clients or for the benefit of me. And so if that leads you into any type of philosophy that I have around it, that may be an answer. Know your risk. Again, it's a similar story, diversification. It likely is going to be your best friend over time. It can be, if you get too concentrated in any one sector, any one asset class, you're exposing yourself to maybe undue risk, right? And very volatile type investment, risky, less proven, right? It's newer in nature, which could be a great thing. Obviously, those that were invested in crypto over the last couple of years are saying they got paid for that risk that they took. But it comes down to is this going to set you up for retirement type discussion, and how confident are we in that exposure?
Now, sometimes when it comes to investing, I've been told, we'll see what the successful people are doing. We hear about was it Warren Buffett?
Yes.
And they say, well, look at how much money he's made and where he invests and see where he's putting his money. Is that a wise or can they put their money in things that are a little more risky because they have it?
Loaded question again.
Yeah.
Yes and no.
full of them.
Warren Buffett is a great example of kind of my philosophy in the world of investing, right? And Warren Buffett and Berkshire Hathaway have been a long-standing company with great returns, diversified portfolio there. And if you listen to some of Warren Buffett's advice, and his advice is to go get diversification, right? And the S&P 500 historically will range from about an 8 to 10% return. Obviously, some years better. We just came off two back-to-back 20-plus return years, right, in 2023 and 2024. And so the law of averages, get you somewhere in between there with dividends reinvested. And so, Warren Buffett's a big advocate for it. A lot of his net worth, I don't have the number, I've read it before, but a lot of his net worth came late in life, and that's because of compounded returns, right? And so he is able to, now his 10% return is a whole lot different dollar amount number than people who are just starting off. But he's proof in the pudding that long-term nature of investing is where you're going to reap the rewards.
Now, if somebody comes to see you and says, hey, Spencer, I want to get set up and I want to start looking at investing. I want to start looking at some retirement planning. I want to start diversifying my money out into different places. Is there a point where you're like, okay, it's great that you want to do this, but you probably want to do more?
Yes, and I've got a range. Some advisors have minimums. I mentioned that before. I do not have a minimum at this point, which is a huge benefit for people in kind of that scenario planning. There are times where people will come to me and say they want to invest and they have credit card debt. And I say, you can't invest until we knock that credit card debt down, right? I'm not going to be spending 20%. I can't get you a 20% return on a continual basis, right? And on a guarantee. So that's been a scenario before. I've come to me that just aren't the right fit, right? And maybe they just they don't understand investments. They have too short-term, narrow of a focus. Hey, what can we do over the next 3 months? That really isn't an ideal client. My ideal client that's coming in, it's those individuals that say, will I have enough? Do I have enough? Is it allocated correctly? Because then I take them through a 3+ meeting, kind of process where 1, get to know each other, get to know your goals. 2, here's your homework, right? Go grab the statements from your 401k. Here's where your assets lie. Let me do some analysis and then implement the retirement plan. And that's saying, okay, based on projections, based on our allocation, if we achieve said return over the next 10 to 15 years, you're set to retire at age 60, right? And Social Security planning will come into play to help supplement income.
Right.
And so it's a long process. I do make my clients work because they get the most benefit from me when we can be as detailed as possible. And they come back and they're so thankful, right? After years of planning and that transition to retirement can be so rewarding, right? To say you're financially independent and you can wake up and go to work if you want, or you can wake up and not go to work if you want and enjoy your life elsewhere. And so starting early, having that conversation, achieving goals, that's what I'm ultimately here for.
I like that you kind of get them involved, make them do a little bit of homework. Because, of course, then if they succeed, they're going to feel very empowered by what they did. And if the market goes down, it's not easily like, well, Spencer, it's your fault.
Right, exactly. And when I show them the financial plan, right, and their retirement plan, I often say, listen, here's what would happen in a 2008, 2009, crisis, right? Here's where, here's your probability of success if that happens, right? You're still okay. I plan for it, right? Here's what happens if we're in a trade war and the market drops by 15% over a 2-month period. Here's what happens. We're okay, right? Let's stay invested. We've got this bucket of money. That's our living expenses for the next couple of years. That's not being impacted. So that's my philosophy on retirement.
Now, if people come to you and set up a retirement plan, do you do, like, I think my 401k, some of it is set up with this is your retirement year, and then some of it's set up in, international this or whatever that. Do you kind of offer the same thing where it's like, we're going to put some here this will maybe rank up aggressiveness or rank down aggressiveness, and then
Yeah, exactly. And so I'm designing portfolios with the help of LPL Research, who LPL Financial is my broker dealer, right? They're my independent, the largest independent broker dealer in the United States. That's who is kind of behind me. They're right behind the scenes. That's who your account is officially held with. That's where your online login comes from. That's whose statements come out to you. And they allow me to brand myself as Synergy Bound Wealth Management. And so, yeah, ultimately, we're designing portfolios based on longer term factors of, okay, this is where we think we succeed, and sometimes near term focus, right? And saying, hey, an opportunity is being presented right now in small cap stocks, let's just say. And small cap stocks have gotten hit hard with recent tariff news. Maybe that's the opportunity we look at. But ultimately, again, I keep going back to this, but an individual case by case scenario, it's unique to be able to customize portfolios specifically to individuals, and we have that ability to create that plan.
initial walk through the door there at the office. I come in, we have an appointment set up, I sit down. What do I need with me on that initial sit down?
That's a great question. I often say as much as you can get without stressing yourself out. I say if you have those statements, oftentimes people usually kind of know where the conversation will land, right, and lead. I'm slower with my process. I don't want a quick transactional deal where, hey, drop off a check and what can you do for me? I'm really hey, why are we investing even? Is it just to make the next dollar, or do we need this dollar to live off of? And so that initial plan statements, your income, your expenses, any debts out there, some of those basic ideas that you have already, and then it's me interpreting, asking questions, interviewing, and kind of getting a feel for what that looks like.
Now, I know people personally who have had wealth advisors before. Maybe it's somebody who had been doing it for 20 years and then they got out of the business, nobody to pass it on to, and now they're sitting there with a portfolio going, I don't know what to do. I don't understand any of this stuff. Or maybe they're with an advisor that they don't mesh with, and they feel like the strategy they want and the strategy the advisor wants, the advisor just does what they want, maybe something like that. If people come to you, can they bring their stuff to you? Can they bring their portfolios to you?
Yeah, that's a great question. That's most common. My most common client, has investment accounts already, right? And they're either one, not getting the service or not getting the attention, or just feel like they aren't important, right? And so there's a number of times where that client walks through the door. I break down the fees, right? Fees are very important in the investment world. How your advisor gets compensated is important for you to understand. And oftentimes it's not very clear. And so I break down, okay, let's compare our fee structure here versus their fee structure there. How much are they taking? How much are you keeping? That's a big one where it adds up over time. And two, let's look at the underlying investment. Let's look at the performance. Let's see where you're allocated. And then, are we being as tax efficient? I find I'm a certified financial planner, right? And so that puts me in a category of really understanding many topics of wealth management and personal financial life. And so there's a lot of tax planning opportunities from either one, a business owner standpoint, two, individuals, right? Should we be doing backdoor Roth conversions? Should we be contributing to a Roth or traditional? At work, I'm just splitting it traditional and Roth. Should I be doing that? I really analyze, okay, hey, here's your tax bracket today. Here's what we're predicting your tax bracket to be when you retire, because we took the time. Right, we took the time to lay that plan out, and that's how we get to implementing and then managing on an ongoing basis. So, that's kind of that initial meeting, and then after that, it's quarterly newsletters from me, emails in tough times like we're kind of going through. I want to know that my clients, I'm out ahead of it a lot of times. I'm picking up the phone, talking with my clients to make sure they're okay, right? Make sure they're sleeping yet. And then two, meeting on a either semi-annual, annual basis, whatever the client really desires, and doing check-ins, right? Are we doing what we said we would be doing? Because that keeps you on track, right? And in given markets like this, maybe it's a conversation, hey, do we have any liquid funds that we could maybe take advantage, right? Set some aside for a longer term. So that's kind of, what it looks like on my side.
Investment wise, is this something where people are setting up like an auto thing where it's like, okay, so once a month I'm going to have you pull X amount add it to my investment and keep growing it? Or can somebody come in and say, hey, I had a really great month last month doing other stuff. Here's a check. Add this to my...
Both.
Okay, both are options.
Both are options. I have a lot of people that automated savings, I often say is great, right? That's what's happening on your paychecks in your 401k. And if you're not at an employer that offers a retirement plan, if you're at a smaller employer, you're not saving enough, most likely, right? You don't have any of that automated savings. Maybe it's then we got to set up an IRA and pull every other week, right? I'm going to time it up right with your paychecks. We're going to take X dollar amount. Or it's monthly, or it's semi-annually. So I have a lot of people on those schedules. And if you're a business listening, I offer 401k, simple IRA, SEP IRA plans, right? If you want to set up your employees for success for their retirement, and yourself, and create some tax advantages as well. That's another offering that I can take a look at and say it makes sense for you. You've grown, your business has grown to a size. It's time to implement a retirement plan. Helps with employee retention. Helps get employees do good for the employees to reach their financial goals, and it can oftentimes lead to success for the business owner or owners for their personal plan as well.
If I'm somebody who does work at a company where I'm not getting a 401k or have some sort of retirement planning set up, is there a percentage you recommend? Because I know nowadays it's like, oh, well, if the company matches up to 4, you should do 4, whatever the case may be. Is there a general percentage number that you can give? I know specifics is tough.
Yeah. I like to say at least 10 to 15% total. And I lean kind of higher to that 15%, right? Younger individuals will not have that pension. Social Security, it needs reform, right? From a funding standpoint, from a payout. We don't exactly know the structure of what that looks like. Are our Social Security benefits going to be what they say they are on our benefit estimate right now? Oftentimes, if you talk to someone that's younger or mid-career, they don't know how much Social Security is actually going to give them at all. They have no idea. And then I say, okay, let's go grab your statement from them. And then they see, okay, that's how much I'll get in retirement. That's not enough to live off of, right? And so that conversation, I like to say 10 to 15%. Oftentimes, just broad advice that may be applicable is, if your employer is giving you that 4, you do 10%, you're at 14% total, all in, right? Getting you on track. But again, to my point, case by case scenario, right? If you plan to work till you're 70, maybe you don't have to contribute as much. Maybe you can enjoy life when you're younger and you want to keep working till you're 70. If you want to retire at 55, we better be up over 15% most likely.
Right. I want to touch a little bit on interest rates. And the reason I do is because we talked about briefly, you were saying if somebody comes in and they've got some considerable credit card debt or things of that sort, that they're going to want to get that paid off. Because, credit card debt, maybe it's, 18, 19, 20%, 28%, depending on how new their credit is or where their credit sits, that they're paying an interest there. The interest return on a savings account or even on the market, chances are you're not going to see anywhere near
exactly
that. What kind of interest are we seeing right now or historically in those places?
Interest rates remain elevated, right? And some of this tariff news is really going to complicate the bond market and the Federal Reserve, because tariffs can be inflationary in nature, right? And the Fed has 2 roles. They're independent of any political environment that's out there,
right?
Completely independent. And so Fed Chair Powell has 2 jobs. One is to keep inflation in check. Around 2% is their target goal. We're not quite there. We're nearing there, but some hiccups along the way could come. And 2, unemployment, right? His job is to keep Americans employed. And so he's got to do this balancing act. So interest rates have remained elevated. Why? Because inflation had to come down. And if the economic output keeps growing, because we have low interest borrowing rates, that could spur more inflation. So his job was actually to cool the economy a little bit. Looked to be holding it off for the most part. And now we have this tariff news that is going to just complicate things. That's the best way I can put it. And so interest rates have been even volatile along with the stock market. But right now, 30-year mortgage hovering around 7%. The 10-year Treasury yield about 4.4%, 4.5%, somewhere in that range. And so those are longer-term rates that we can kind of say that's what the market is predicting rates to be. I think come May and June here, we're going to hear a lot from the Fed and Chair Powell. And so that could clear up the muddiness right now of where rates land. But a lot of people in the mortgage conversation right now, do I buy at these rates? And I always say you can date the rate, marry the home. If you find that home that you love, the ability to refinance if rates come down is always there. But you have to be comfortable with that monthly payment, and it has a large impact on borrowers.
That makes a lot of sense. I want to go back a little bit and talk about, you said, people can have logins and stuff to check things through, I forgot the name of the company you said.
LPL Financial.
LPL, there you go. For the people who, and I'll admit this is me from time to time, that like to check things on, sometimes hourly basis. I'm not quite that bad, but I know people, they know their bank account 3 or 4 times a day. They got it open, they look at it, even though they've spent no money. Is that something they can do on this website as well? They kind of
absolutely. Yeah. So, sometimes it's a good and bad thing, right? I always love my clients that are in tune with their finances, because it really sets this transparent relationship between me and them, right? They can come to me anytime and they're going to know their numbers. I've got other clients have the login, never log in. I think they open their monthly statements. I hope they do, but I'm not sure that they do. So I have this range, but yeah, as many logins, as much checking as you want to do, you're gonna get that transparency from me. And during hard times, I often say, hey, maybe let's wait 30 days before logging back in, right? And if it's going to cause you undue stress, let's check ourselves.
That makes a lot of sense. And, it can also lead to, again, those knee-jerk reactions. Yeah. We want to avoid those. Let's talk a little bit more about retirement planning, because there's a lot that goes into it. Obviously, your investments in the market can be one thing. 401ks, pensions, if you have it, is another thing. Knowing what your Social Security is, we talked about that. That's yet another option out there. Are there any other things that we can do when it comes to planning for retirement that maybe we haven't touched on just yet?
Yeah. There's a lot. There's a lot that I uncover during those meetings. Some topics, and a lot of times it relates to tax. And I defer to tax advisors, CPAs on specific tax advice. But I can educate the best I can do. And so sometimes that's Roth IRAs, right? You're putting in tax-free dollars, tax-free growth of that account. And those are meant for retirement, right? You're looking to get past a magic number of 59.5 when you start to access IRA funds in most scenarios. There are certain scenarios that you can get at it sooner. But so a lot of times it's implementing a Roth IRA and saying, hey, if we can contribute either $7,000 or $8,000 a year, or any dollar amount that we can do, we do that annually for the next 10 years. Here's where your number is going to be. Thanks to that, here's how much investment growth was. All of that investment growth is now tax-free when you take it out in retirement. So that's a common one. Health savings account. If you got a high deductible health insurance plan, I do not manage health savings accounts. I have no interest, in opening health savings accounts, but it's something that everybody should be educated on, because you put in money, tax deductible, it can be invested, grows tax-free. When it's taken out for medical expenses, it is tax-free, right? So we call it a triple tax savings, and a very powerful tool. Some people just are not at all even aware that that's out there.
Right.
So a lot of those conversations, and then placement of assets as well. If someone's like, hey, I'm kind of aggressive, I think the market probably goes up over time, but I also don't want big fluctuations, right? We can bucket money in different areas, right? Whether it's brokerage account, Roth IRA, traditional IRA. If you've got old retirement accounts out there, a lot of times when someone leaves an employer, they don't know what to do with their old plan, right? It's sitting at Fidelity, it's sitting at American Funds, wherever it may be, and it's just been sitting there. They haven't had a checkup in it. They don't truly understand the power of it. A lot of times that's an opportunity to start a conversation as well.
Yeah, no, I made a big mistake. My very first 401k that I had at a company, I left the company, and I didn't do anything, and I didn't respond. And eventually they said, well, hey, where are we sending your check? And I thought, oh, what do you mean check? Check shows up. There it is. That's what was in your 401k, what you had vested in it. There you go. And I didn't know the understanding was that was to kind of roll into something else or move into something else. I just saw it because I was young and dumb and went, oh, here's a check for a couple grand. What should I do with this? Now I have a better understanding because that's not something they teach you.
Right, exactly. And that's an opportunity. Maybe the brainstorming from before, where advisors in the area can get out and be involved in trying to help those individuals and those young professionals where they don't have a better place to go. Then they don't want to make a mistake. They don't want a 10% extra penalty or to pay taxes on something. So that's a great opportunity as well. To have a conversation.
Well, we are starting to wind down to the bottom of the show here, so I do want to give you another moment to let everybody know, how do they find you? How do they get in contact with you? Websites, Facebook, address, phone number. Give us a little rundown.
Yeah. So synergyboundwealth.com. That's your best starting point. I've got a tab on there that you can request a meeting right from there. Right. So without even picking up the phone, you can log in synergyboundwealth.com and simply say schedule a meeting, schedule a time to talk. And then we'll have a conversation. Otherwise, call me, email me. Phone number here, 414-299-0003, located at 121 Front Street, suite number 4. So right next to American Bank downtown. And I look forward to helping the listeners and helping empower people to be financially independent.
There you go. Well, Spencer, I want to thank you for coming in today. I am going to read your disclaimers one more time for everybody.
Please do.
Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance reference is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal. This has been a paid program. The advice and opinions expressed during the program are solely that of Synergy Bound Wealth Management, not necessarily WBEV or Good Karma Brands.